Hello everyone, my name is David Pensyl and I'm a certified financial planner professional at Lincoln Investment. In today's video, we're going to discuss the One Big Beautiful Bill Act, and in my opinion, 10 ways that it could affect your finances. I want to give a shout out to Ben Henry Moreland and his article on Michael Kitches's website titled Breaking Down the One Big Beautiful Bill Act and its impact of new laws on tax planning, as well as the Money Guy Show, and their video titled The 5 Things You Need to Know About the One Big Beautiful Bill Act. Much of the content in this video was derived from those two sources, which will be linked below. There is a lot we need to get into, so let's get started. To start us off, the One Big Beautiful Bill Act was signed into law on July 4th of 2025. It has made many of the provisions of the 2017 Tax Cuts and Jobs Act permanent, which were supposed to expire at the end of this year. There are 7 marginal tax brackets which were implemented by the Tax Cuts and Jobs Act. These are the 10%, 12, 22, 24, 32, 35, and 37% brackets. These are now permanent thanks to the One Big Beautiful Bill, or as permanent as they can be by Washington, D.C. standards. The only minor difference in the federal marginal tax brackets between the Tax Cuts and Jobs Act and the One Big Beautiful Bill are in the 10 and 12% brackets for all filing statuses, which gives those two brackets in particular a small inflation adjustment starting in year 2026. Next up is the increased standard deduction, which is a fixed dollar amount that taxpayers can subtract from their adjusted gross income, or AGI, to reduce their taxable income. Taxpayers can choose to itemize their deductions or just use the standard deduction, and you would obviously choose the amount that gives you the larger overall deduction. According to the Tax Policy Center, as part of the Brookings Institute, roughly 90% of the U.S. taxpayers opt to use the standard deduction. This One Big Beautiful Bill has introduced changes to the standard deduction, including increased amounts and new temporary deductions. It has increased single taxpayer standard deduction from $15,000 to $15,750, increased heads of household from $22,500 to $23,625, and has increased married couples filing jointly from $30,000 to $31,500. All of these amounts are now permanent and will be adjusted for inflation starting in January of 2026. The One Big Beautiful Bill Act includes a temporary tax deduction for seniors, those aged 65 and older. This deduction is $6,000 for single filers and $12,000 for joint filers, and is effective through 2028. There are phase-outs involved with the deduction though. Households with a modified adjusted gross income of $75,000 filing single and $150,000 filing jointly are subject to a phase-out tied to the amounts of the household's modified adjusted gross income. In effect, households with modified adjusted gross income of over $175,000 filing single and $250,000 filing jointly will be entirely phased out of this new deduction. Those 65 and older can use this deduction on top of the additional deduction already in place for seniors 65 and older or blind, which leads us actually into number 4. There will be no direct Social Security tax elimination. There has been some confusion on this given that an email was sent out by the Social Security Administration shortly after the One Big Beautiful Bill Act was signed, stating that 90% of Social Security beneficiaries will no longer pay federal income taxes on their benefits. The temporary tax deduction discussed in number 3 could indirectly lower the portion of Social Security benefits that retirees must pay federal income tax on. However, it does not explicitly eliminate tax on Social Security benefits. The temporary deduction is agnostic about the type of income it's offsetting and would be available regardless of whether the individual was receiving Social Security benefits or not. The One Big Beautiful Bill Act will expand the uses for 529 college savings accounts. I say college savings accounts in quotations because the types of expenses that can be paid for these types of accounts have now significantly expanded. In addition to the changes made a few years ago allowing up to $10,000 to be used for K-12 primary education, there will be more distributions allowed for K-12 expenses for students enrolled in public, private, or religious schools. This includes increasing the original amount from $10,000 to $20,000 beginning in 2026. They have also expanded on the types of expenses that $20,000 can include. It can now be put towards educational materials, curriculum materials, textbooks, supplies, tutors, standardized tests, college placement tests, AP course expenses, dual enrollment fees, and educational therapies for students with disabilities. There are also new additional qualifying expenses for post-secondary education, like fees for exams necessary for career credentials, fees and costs for continuing education necessary for those credentials, and it's required that these credentials be accredited by an industry-recognized institution such as the Certified Financial Planner Certificate Program. A common goal of parents that I talk to is that they'd like to jumpstart their children's retirement while they are still young. Many of the current available options can create challenges to making this a reality. Minors can open Roth or traditional IRAs, but they need to have earned income in order to do so. UTMA and UGMA accounts are an option, however, they must be turned over to the child once they turn the age of majority in the state, which means there's no guarantee the funds are used for their original intent. 529 plans are generally limited to educational expenses, although new rules allow some of the money to be rolled over to a Roth IRA if the account has been open for 15 years. These limitations have paved the way for what's being called the Trump account. These are essentially IRAs for minors that have no earned income requirement, and the contributions from parents and guardians are not tax deductible. They can be funded up until the year before the child turns the age of majority. Currently, children born January 1st, 2025 through December 31st, 2028 are eligible for a Trump account, although they may expand this in the future. According to the new law, a pilot program with the intent to jumpstart the use of the accounts has been instructed to have a $1,000 credit paid by the U.S. government into the Trump account on behalf of an eligible child upon opening. Custodians can put up to $5,000 into the account per year starting in 2026. Government and charitable groups can contribute to the account as well, and it does not go against the $5,000 yearly deposit limit. Also, the custodian's employer can put up to $2,500 into the account per year in addition to the $5,000. After the beneficiary turns 18, the account becomes like a traditional IRA, although it would probably be very important to keep track of what contributions were pre-tax and which were after-tax for taxability purposes upon distribution. No distributions can be made before the beneficiary turns 18, and after that, any distributions before the beneficiary is 59.5 are subject to general IRA early withdrawal penalties. Many of the rules regarding this account are still unclear, including rollover, required minimum distribution, beneficiary distribution, and custodial requirements, but we are hopeful more clarifying language is provided in the near future. The new provision does not explicitly eliminate taxes on tips. Tip income remains subject to payroll taxes and may also be subject to state income tax. However, it establishes a deduction up to $25,000 for qualified tip income effective from 2025 through 2028. To be eligible, the taxpayer must be employed in an occupation that traditionally and customarily received tips before 2025. Furthermore, the tips must be voluntary, that is, not required as part of the service, and the amount must be determined solely by the payer. Tips earned through a specified service trade or business are excluded from this deduction. The deduction begins to phase out at a modified adjusted gross income of $150,000 for single or head of household filers and $300,000 for joint filers, decreasing by $100 for every $1,000 above these limits until it's completely phased out. For those who earn tips through a business they own, the deduction is capped at their net business income. Similarly to the previous provision, this does not explicitly remove taxes on overtime income, but introduces a deduction for qualified overtime pay, effective again from 2025 through 2028. The deduction limit varies by filing status, with joint filers eligible for up to $25,000 and all other filers eligible for up to $12,500. It applies only to overtime wages earned above an employee's regular rate and is claimed as a below-the-line deduction, meaning it is taken after adjusted gross income is calculated and is available whether the taxpayer itemizes deductions or claims the standard deduction. The phase-out rules are like those for tip income deduction, beginning at a modified adjusted gross income of $150,000 for single and head of household filers, and $300,000 for joint filers, with the deduction decreasing by $100 for every $1,000 earned above those limits. Unlike the tip deduction, which has the same maximum for all filers, the overtime deduction amount differs depending on filing status. The new tax deduction applies to interest paid on car loans for vehicles purchased between January 1st, 2025 and December 31st, 2028. Taxpayers can deduct up to $10,000 of interest annually, though the deduction phases out for single filers with a modified adjusted gross income above $100,000 and joint filers over $200,000, disappearing entirely at $150,000 and $250,000 respectively. This deduction is available only for interest on new car loans taken out after December 31st, 2024 for personal use vehicles. Loans must be secured by a first lien and cannot be made by related parties. Lease payments are excluded, but refinance loans may qualify up to the original loan amount. Eligible vehicles include new cars, minivans, vans, SUVs, pickup trucks, and motorcycles weighing less than 14,000 pounds and designed for public roads. Used cars, trailers, ATVs, campers, and vehicles not assembled in the U.S. are ineligible. The vehicle's final assembly must occur in the U.S., which can be verified using the vehicle information label or by decoding the VIN through the NHTSA website tool. As an above-the-line deduction, it can be claimed even when taking the standard deduction, and the VIN must be reported on the tax return. Buyers should also factor in overall ownership costs such as purchase price, insurance, and maintenance. Tax savings will vary based on the taxpayer's brackets, and some experts suggest that a few auto loans will generate enough interest to fully utilize the $10,000 deduction limit. The bill permanently raises the child tax credit from $2,000 to $2,200 per qualifying child and indexes the credit for inflation in future years to preserve its value. It also introduces a refundable portion of the credit, enabling lower income families who owe little or no taxes to benefit from the expanded credit. To be eligible for the increased amount, both the child and at least one parent must have a valid Social Security number. Early updates regarding the One Big Beautiful Bill suggested that the backdoor Roth IRA strategy was going to be eliminated with the passing of this law. However, now that the bill has passed, this is not the case. I'd like to briefly summarize the backdoor Roth strategy for anyone who isn't aware. Roth IRAs are retirement accounts where the contributions are not tax deductible. However, the contributions and growth, which can be substantial if you've held the account for a long time, are completely tax-free upon withdrawal as long as you satisfy two rules. One, you've had the account open for at least 5 years, and two, you're at least 59 and a half when you withdraw. This is a huge benefit to anyone who has a long time horizon until retirement. What many don't know is that there are income limits to making contributions to a Roth IRA. As of 2025, those phase-out ranges top out for single filers at $165,000 and for married filing jointly at $246,000, which means that you cannot contribute to a Roth IRA at all if you are above those income limits. But you can contribute to a non-deductible traditional IRA and then immediately convert it to a Roth IRA. As long as there is no growth on that contribution, it's not considered a taxable event, generally. There is something called a pro rata rule, which could throw a wrench in this strategy, but that's a conversation for another video. While the backdoor Roth IRA strategy has withstood previous legislative efforts to eliminate it, ongoing debates in Congress are increasingly focused on restricting or ending its use. Lawmakers have raised concerns that this strategy mainly benefits wealthy individuals and deviates from the original purpose of the Roth IRA. The House Ways and Means Committee has previously proposed banning both the backdoor Roth strategy across all income levels. However, for now at least, the backdoor Roth IRA strategy lives on. I hope this helped clear up the biggest ways the One Big Beautiful Bill Act could affect your personal finances. And if you have further questions on the provisions I just covered, or if you'd like to have a further conversation on how any of these new rules pertain to you, I would love to help. My contact information is linked in the bio below. Thank you, and I look forward to seeing you all in the next video.